Hey guys, and welcome to yourpropertyclub.com's presentation. I'm Brett Alegre-Wood, and this is how to profit from the off-plan boom of 2009 to 2016. Okay, so what today we're going to look at is introduction to buying, flipping, and making money from off-plan new build property. All right, content. So we're going to look at the background. We're going to look at what is off-plan property, why you'd want to buy off-plan property, the process of buying, exchange bonds and deposits, off-plan and the property cycle, how you're going to make money out of off-plan, and the strategy, okay? Then we're going to look at the risks associated with off-plan property, and then we're going to produce a checklist for you, so if you're going into off-plan, you can do it. And then we'll look at next steps, the next steps that you can take to get involved and take advantage of the really massive opportunity that's going to be presenting itself, and in fact already has started to present itself. All right, background. 2009 through to at least 2016, given the current market conditions, will be the time for off-plan. As more and more developers jump back into the market and pick up the supply side of the equation, this will present many opportunities for investors to make profits without the need for ever actually having to own a property. Okay? An upward trending property cycle means that literally everything with good solid fundamentals will see capital growth. The earlier you get in, the earlier you'll be able to take out a profit and build your portfolio bigger with less risk. Now, developers are willing to incentivize off-plan purchases as this gives them the ammunition they need to convince the banks to lend them money to complete the development. In return, you're buying a property at rock bottom prices with an upward trending market on your side. Huge returns await the astute investor. Okay, what is off-plan? It's not so much that it's off-plan property, more that it's property at the stage of off-plan or off-plan build stage. Technically, buying off-plan is the act of purchasing a property that's yet to be completed. And normally this will mean it's still at the planning stage, off the plan, or without dirt having been moved or foundations laid. More practically, it means property that you can't exchange and complete simultaneously on. All right, now if you're looking at this, realistically, what I call off-plan property, and practically what it means is this. If this is a completion date, I take 3 months out. Anytime in that 3 months, I consider to be new build or what we call stock, okay? Anytime from 3 months back to as far as, the planning stage goes, is what we're considering. So off-plan really means, something that's off the plan, all right, before completion. The buying process. All right, so first of all, we've got reservation. This is where you're normally going to pay anywhere from £500 to £1,000 to reserve that property for a period of 28 days. You're then going to have to, in that time, sometimes you'll organise a mortgage, but very rarely, normally you're going to exchange without mortgages, which is one of the risks that we face. You exchange, normally 28 days later. All right, now, importantly, you're committing to buy the property here. Even though you haven't legally completed it, you're effectively exchanging equitable title. And by exchanging equitable title means that you own all the capital profits and you own all the capital losses. Okay? This is why it's so fundamental that you only do off-plan in certain stages along the buying cycle or the property cycle. Otherwise, you can get burnt, especially if the market's downwards trending, then you can really make it or create a lot of damage for yourself. All right, after exchange, you wait, all right? And realistically, you wait and you wait some more. Sometimes up to 2 or 3 years is going to take. Some of the bigger sites, 2 or 3 years are going to be the build time, all right? Smaller sites, not so much, maybe 18 months, 12 months. Realistically, you're looking at, that sort of time periods. Now, you're waiting some more, and then you're going to have delays. So then you're going to be expecting completion in January this year, and actually it won't be until May next year. So delays, and then delays some more, okay? It's a natural part of buying off-plan property, but it's almost always in your favor. And the reason that is because if the price is starting here, and it's an upward trending market, the longer it takes, the further it goes up without you having any mortgage or rent or tenants or wear and tear on your property. So it's in your favor. All right, now finally, completion. Now completion is exactly the same whether you do off-plan, stock, whatever. Okay. The only difference is you're going to have previously exchanged, so you won't need to do the exchange part. Now normally what will happen is once completion is due, you'll get 10 days notice, or your solicitor will get 10 days notice to complete. You've got to complete within that 10 days. If you don't complete within 10 days, you're given a further 10 days what we call penalty notice. Then if after 20 days, so 10 and 10, you haven't completed, the developer can then rescind the contract and sue you. Well, they'll keep your deposit for sure, but then potentially they can sue you. Now, in an upwards trending market, normally they'll resell it at a higher price. Okay, so it's in your interest to make sure that if you exchange on a property, you complete on that property. Okay, unless you can find someone to buy it from you, and we'll talk a bit later about that. All right, deposits and exchange bonds. Deposits required range from 5%, 10%, 15% cash deposits, okay? Or they could be a staged payment structure such as 5%, then 6 months later 5%, or 5% on exchange, and then 5%, 6 months out from completion. Any sort of structure, it'll all be written in the exchange contract. All right. The other alternative that's becoming much more popular, and one that we always suggest, is that you can use an exchange bond. It's simply an insurance policy that the developer uses to redeem the deposit if you fail to complete after exchange. So if you've exchanged and then you fail to complete, what they do is they cash in the insurance bond, and the insurance company pays the developer. So the developer gets his money, okay, the exchange money, not the rest of the money, but then they'll sue, the insurance company can then sue you for that money. So it's not a get out of jail free card. So it's vitally, vitally important. I'll say it a number of times in this presentation. If you're going to complete or exchange on a property, you've got to be prepared to complete on it. You've got to have the money to complete. Now, an exchange bond, you're looking as a rule of thumb, it's going to cost you about 1% of the property price. £100,000 property price will cost you about £1,000 for the exchange bond. 200,000, 2,000. Okay, and it varies depending on whether it's a 5 or a 10% or a 15%. It varies on time, but as a rule of thumb, if you work on 1%. All right. Now, upon completion, all that happens is you front up with the money and complete, the exchange bond lapses. If you can't front up with the money, that's when the exchange bond gets cashed in by the developer effectively. All right, off plan in the property cycle. Okay, so here's a normal property cycle. We talk about it shooting up, sitting, stagnant, shooting up. This is if you're holding a property, okay? Now, if we look at the next thing, if we look at, and this is my sort of property cycle that I work with, shoots up, overshoots, compensates, and then slow, steady growth up, and then it'll drop off the edge, which effectively is what we call recession, okay? And then after the recession, it'll shoot back up. Now, if we're looking at that as being our model, when will we do off plan? Now, we've got a couple of things, all right? If we're looking at this phase here, so still shooting up, but starting to get overheated. The economy's starting to get overheated. Probably we're talking about bubble bursting. We're seeing interest rates maybe starting to, creep up, or there's talk of it. Okay, that's that stage of the cycle. Now, here you got to buy with caution, all right? Because what you don't want to do is buy something that then is going to decrease in value. Now, most of the stuff, if it's long-term off plan, will be okay here, or shorter term, sorry, off plan is going to be okay here. All right, so proceed with caution through this phase. Now, next phase, okay, this is the stop. You don't want to be doing this, because the last thing you want to do is have off plan and then all of a sudden it fall off the edge of a cliff, if you like. Now, if you're talking about here, the point which we fell off the cliff was effectively September 07. The last recession which we're looking at. So realistically, that we should have, before that, and for the previous 2 or 3 years before that, we weren't doing off plan as a company. And the reason was specifically because of this, the dangerous zone of off plan. All right, and this is where a lot of people who think they can just buy and flip and sell and do all these things, actually in this phase they can't. Now, that's not to say it's not possible. That's not to say that you don't do off plan in these phases. If you've got long-term off plan and really long-term off plan, or you've got really good solid fundamentals, then by all means jump in and get involved, okay? Or shorter term off plan, through here. But you've got to know what you're doing in this phase. A lot of people lost a lot of money, and we'll look at some example later of a real life example of people who lost money by buying in that danger zone. All right, so flipping through this phase is highly unlikely. As much as every salesperson will try and tell you, buy 2, flip 1, pay for the other one, it's fantastic. Actually, it won't happen, all right? Now, that's not to say it can't, but it's highly unlikely. All right, so let's look at the next phase. All right, this phase, buy anything with good solid fundamentals.